Hello everyone and welcome to the video blog with the Rafael del Pino Foundation. Today we're going to talk about bond yields, why sovereign bond yields rise in an environment of massive central bank intervention. Central banks implement quantitative easing with basically one idea, which is to focus their policy on increasing inflation and also to generate what is called financial repression, which is to take out of the market the most safe asset, the safest asset, sovereign bonds, in order for savers to take more risk, invest in the economy, and generate what is the transmission mechanism of monetary policy, which is basically that the central bank acquires the safest and most secure asset. And therefore, banks have higher tolerance for risk. They take more. They give more credit, and investors invest in the more cyclical side of the economy. And basically, investment and credit run more smoothly. They increase a little bit more. That idea is predicated on the fact that the sovereign bond is mispriced, that there is that the bond yields that sovereign issuers have are incorrect, and therefore the central bank acquires those bonds, makes a profit because it understands the risk better, and at the same time the credit mechanism improves because banks are not suffering from having a bloated balance sheet full of sovereign bonds, and they can start to lend to the real economy. That idea is good until central banks do what they have been doing throughout these years, which is that instead of purchasing a mispriced asset, sovereign bonds, they have been making sovereign bonds massively expensive. That's why what we have seen is that some of those bonds that the central bank was buying started having negative real and nominal yields. Therefore, the price of those bonds goes from being heavily mispriced in terms of being massively cheap or very attractive in a crisis to being monstrously expensive in an environment of recovery, even in an environment of growth, as we saw between 2016 and 2019. When the mispricing of sovereign bonds is so severe that they provide negative nominal and sometimes real yields, what happens is that financial repression reaches an extreme in which buyers of sovereign bonds will only do it because they expect the price, because the yield is very low, they expect the price to appreciate very aggressively because of the massive repurchases of central banks. Now, see what happens. When the sovereign bond is not reflecting inflation expectations and its price is so expensive that it is massively not considering the real risk included in the solvency ratios and the liquidity ratios of the sovereign issuer, what happens is that the difference between inflation expectations and the yield of the sovereign bond are so out of proportion that even a very small increase in inflation expectations leads investors to sell and to get out of the sovereign bond market. Why? Because they will get massive losses if inflation continues to be above the nominal and real yield of sovereign bonds. So this is what's interesting, is that central banks are trying to create inflation, and at the same time their policy doesn't work if they do. Particularly, their policy doesn't work if they create inflation and continue with the expansionary policies, which inevitably will lead investors to get out of the two extreme parts of the valuation part of the economy: the sovereign bonds, which are the most expensive, and the more cyclical assets that depend on the growth of the economy. So repression of bond yields actually can create a financial crisis quicker simply by a very modest change in inflation expectations. And that change in inflation expectations is not going to be reversed with messages of more dovish policies, because when central banks come and say, don't worry, we will continue to inject liquidity into the economy and keep rates low, the difference between the reality perceived by investors and citizens leads to two things. First, citizens don't take more credit. Investment banks and companies, etc., they don't take more risk or originate more borrowing or more credit to the real economy. And at the same time, investors stop buying the fallacy of central banks will rescue the elevated levels of valuations at any cost. And this comes from a very, very mild change in inflation expectations. And the reason why is because the bubble of everything is so expensive and everything is so bloated in terms of valuations that it can crack with the smallest change of inflation expectations. So what central banks then will do, and they do, is to say first that inflation expectation increases are not important because they're temporary. But it doesn't matter, because the losses that can be created in 2-3 months of rising inflation are so huge that it is not going to make people continue to run more risk at a lower yield. Financial repression always leads to too much risk, and when too much risk is taken with the idea that central banks are going to save us from any of our wrong investment decisions, then a crack in the system can come from a very, very limited change in inflation expectations in this case. Thank you very much.